We are starting part 3 in the accounting textbook. It's accounting for a merchandising business organized as a corporation, adjustments and valuation. So now we're talking about a company called Sun Treasures Inc. Sun Treasures Inc. is the business described all throughout part 3 as a retail merchandising business organized as a corporation. Sun Treasures purchases and sells a wide variety of souvenirs. It rents freestanding buildings near East Florida beaches. The corporation was originally organized and owned by Nathan Morgan. Over time, he sold common stock to family members and gave stock to his children. Several years ago, the company sold common stock to the public. The Morgan family still owns over 50% of the outstanding shares. The Morgan family holds 5 of the 7 positions on the corporation's board of directors. The board has adopted a 10-year plan to expand its business to the Florida West Coast. The strategy includes opening new retail stores and a distribution center in Central Florida. So that is what we are talking about during this unit. We're going to start out with Chapter 18. Acquiring capital for growth and development. So when a company wants to expand, it needs money. It needs capital so that it can grow and develop new things. So first of all, short-term debt financing. You guys have already learned about buying on account, which is similar to short-term debt financing. And you've also previously learned about operating expenses. So today we're going to learn about non-operating expenses. Short-term debt financing options. Every business needs cash to pay its operating expenses. Purchasing inventory and paying the payroll are examples of daily activities that require a business to earn revenue. The payment of an operating expense necessary to earn revenue is called a revenue expenditure. Let's see. So over an extended period of time, a business must generate enough cash from sales to pay expenses. But from time to time, a business may find itself short of cash. When this happens, the business may need to borrow money for a short period of time. Obtaining capital by borrowing money for a period of time is called debt financing. There are several ways for a business to borrow money from a bank or other financial institutions. But right here it says a bank loan agreement that provides immediate short-term access to cash is called a line of credit or a credit line. There are different kinds of credit lines. The loan agreement sets the maximum amount that can be borrowed and the repayment terms. It will also set the interest rate and the length of time the agreement will be in effect. The business can draw any amount it needs within the terms of the loan agreement. Last thing it says here is the interest rate charged to a bank's most creditworthy customers, those are the best customers there are, is called the prime interest rate. For example, a line of credit may have an interest rate of 2% over prime interest. This rate would be stated as prime plus 2%. So first example, we have November 14th. They drew $15,800 on its line of credit using receipt number 912. So we have to fill out a cash receipts journal. So Sun Treasures has arranged a line of credit with First National Bank that provides the company with immediate access to a maximum of $50,000. Sun Treasures can transfer money from its line of credit to its checking account using an internet site or by calling a bank loan officer. Sun Treasures pays an annual interest rate of prime plus 2.5% on its daily outstanding balance. The line of credit requires Sun Treasure to pay monthly interest and pay at least 10% of its outstanding balance at the end of every month. So Sun Treasure draws on its line of credit to prepare for its peak selling season. The company regularly maintains an inventory of about $150,000. However, during its peak selling season, the company increases its inventory to over $200,000. Okay, so our cash and our line of credit is affected. The first thing we're going to do is fill in the date, November 14th, and then the account name, which is line of credit, and then the receipt, number 912. Okay, the total amount borrowed is $15,800, and that is a credit, and then the cash deposited is $15,800 in the cash debit column. Signing a promissory note for an extension of time. A business that is unable to pay its account when due might ask the vendor for an extension of time. That is when the vendor is going to ask the business to sign a promissory note. The note does not pay the amount owed to the vendor. However, this is important because the form of the liability changes from an account payable to a note payable. When the entry is posted, the balance of the account payable account goes to zero, and then one liability, the accounts payable, is replaced by another liability, the notes payable. The interest rate on promissory notes for signed with a vendor can be pretty high, so it's just not a good idea. You should avoid signing a note for an extension. Instead, I would consider borrowing funds against a line of credit or obtaining a loan from the bank. So our first example, on September 30th, Sun Treasures signed a 60-day 12% note to Haas, Inc. for an extension of time on its account payable using memorandum number 142. So our general ledger accounts payable, in our general ledger, the accounts payable account is affected, as is the notes payable account. And then in the accounts payable ledger, the Haas Inc. account is affected. So we're going to put in the debit accounts payable and vendor's account. So we have a slash here on purpose, accounts payable and Haas Inc. Our credit notes payable line item, we have memorandum number 142, a debit of $4,200 and a credit of $4,200. Paying principal on and interest on a promissory note. When a promissory note reaches its maturity date, that's its due date, the maker of the note pays the maturity value to the payee. Interest incurred on borrowed funds is called interest expense. The interest incurred on a note is debited to an expense account titled interest expense. Expenses that are not related to a business's normal operations are called non-operating expenses. Interest expense is a financing expense rather than an operating expense. Non-operating expenses such as interest expense are listed in the section of the chart of accounts titled Other Expenses. So on November 29th, paid cash for the maturity value of the August 30th note, principal of $4,200 plus interest of $84. The total of $4,284, which is check number 751. I'm going to get out the calculator really quick. Hold on. It's important for you to figure out, actually it's right there. Let's turn that back on. We need to figure out how this interest is calculated. So we have the principal times the annual interest rate, time as a fraction of a year. We did this earlier this year in a lesson, but it's a review that would be $4,200 times 0.12 times 60 divided by 360 gives you the interest for a fraction of the year. The accounts that are affected And then we fill in our cash payments journal. So first we're going to write the account title, which is notes payable in the title column. Okay, we have check number 751, accounts title, interest expense, okay, the principal amount, the interest amount, and then we add them together to get the cash paid total. All right, that's it. What information is specified in the loan agreement for a line of credit? The loan agreement specifies the maximum amount that can be borrowed, the interest rate, term of the agreement, and the repayment terms. Is interest expense an operating or non-operating expense? Oh, sorry, that's the next one. On a line of credit, how would an interest rate of 3% over the prime rate be stated? You would state the words prime plus 3%. Is interest expense an operating or non-operating expense? That's an easy one. It is non-operating. Where is interest expense listed in a chart of accounts? In the section titled Other Expenses.